Good morning, everyone, and welcome back to another episode of Capital Markets Quickie. I'm your host, Endrit, and let's dive right into what's been shaking up the markets recently. So, Monday was quite the roller coaster, wasn't it? Despite the rising tensions in the Middle East adding to the concerns we already had with interest rates and inflation, stocks said, "Nah, I've got this." They ended the day in the green. Now for some specifics. The Dow Jones, it climbed by 0.6%, which is close to a whopping 200 points. The S&P 500 didn't want to be left behind and also rose by around 0.6%. And our tech darling, the Nasdaq, well, it had a more modest climb of about 0.4%. Let's take a moment to talk about the cause of this market ripple. Over the weekend, Hamas launched an attack on Israel, which, as you can imagine, led to a massive declaration of war in return. And if that wasn't enough, we've already got the conflict between Russia and Ukraine. Jim Reed, a strategist from Deutsche Bank, made an interesting point. He said, and I quote, "Geopolitical risk doesn't tend to linger long in markets, but there are many second-order impacts that could come through in the weeks, months, and years ahead from this weekend's developments." Now, how did this impact other sectors? Oil prices, for instance, saw quite the jump. With the increasing worries that major crude producers might get dragged into the conflict, WTI crude oil and Brent crude futures surged by over 4%. Gold and government bonds, well, they were in hot demand. A shout out to defense-related stocks too. Lockheed, Martin, Northrop Grumman, and General Dynamics, they experienced boosts of 9%, 11%, and 8% respectively. Impressive, right? But beyond these movements, there's the bigger picture. Investors are slowly coming to terms with the fact that borrowing might remain expensive for a while. And why is that? Well, the September jobs report turned quite a few heads, suggesting tighter policies might be on the horizon. The bond market has also been giving investors some sleepless nights. With bond yields hitting 16-year highs, there's mounting anxiety about how further rate hikes might impact the economy. But hey, this could give the Fed a reason to think twice about its rate hiking strategy. As we wrap this up, keep an eye out for the Consumer Price Index for September, dropping this Thursday. It might show a dip in headline inflation. Also, for those keen on getting a peek into the Fed's mind, the release of minutes from their last meeting this week should offer some clarity. Well, there you have it, folks. A whirlwind of events in our financial world. Until next time, keep your ears here for the latest in capital market updates. This is Capital Markets Quickie, signing off.